Hello, my name is Zach Backner, and I am the Director of Financial Planning here at Summit Financial Consulting. Thank you for joining us today. This video is going to be discussing the upcoming Federal Reserve meeting and how their interest rate decision may impact the overall economy. One of the hottest conversations lately has been the Federal Reserve and their decisions towards monetary policy. This video is going to be diving into how their decision may impact the overall economy as well as bond investments. We will also touch on expectations for the upcoming Fed meeting in mid-September. We previously discussed in a blog post on our website, summitfc.net/blog, about how specifics of monetary policy and how that may differ from fiscal policy. You can read more about that on our website. First, let's discuss what monetary policy is and how interest rates are included in that decision. The Federal Reserve has the goal to bring stability to the economy in terms of unemployment and inflation data. By tightening or easing policy, they could potentially impact both of those data points. A tightening economy is caused by higher interest rates, which will typically see less spending in terms of businesses and consumer spending. Under this type of environment, we are likely to see an increase in unemployment since businesses often do not have the cash flow available to hire or retain employees if their access to debt is more limited by those higher interest rates. Also, since businesses and consumers are likely spending less, there is potentially a decline in demand for goods overall, which could cause prices or the inflation rate to decline. An easing economy is partially the result of lower interest rates, which normally allows people to spend more since the cost of debt is cheaper in this type of environment. More spending means businesses can likely afford more employees, so unemployment can potentially go down, and also a higher demand for goods, which may impact prices and inflation to rise in this scenario. The Federal Reserve affects broad interest rates by setting the Fed funds rate, which is essentially the cost for banks to borrow or lend money to each other overnight. The Fed funds rate is a super short-term cost for banks that is controlled by the Federal Reserve. The effect of adjusting this Fed funds rate is that it causes the borrowing by banks to have a new cost, which in turn gets passed on to their businesses or consumer clients who take on new loans. An increase in the Fed funds rate will broadly mean an increase in interest rates associated with the cost of debt at that point in time, which will likely lead to a tighter economic condition. While a decrease in the Fed funds rate typically means a reduction in interest rates, so this tends to lead towards easing monetary policy. Besides the underlying economic impacts, it is important for investors to understand how interest rates may affect their investments, specifically bond investments. Bond values have an inverse correlation to interest rates, which means bond values go up as interest rates go down, or bond values go down as interest rates go up. We'll go through a quick example. Let's say you currently hold a bond that is paying 4% interest. If interest rates go up to 5%, your 4% interest is not as desirable, so your bond value is going to go down. However, if interest rates go down to 3%, your 4% paying bond is now more attractive, so your bond value will go up. There are many factors that go into a bond valuation, but this is a very high-level example of how interest rates may affect a bond's value. Lastly, we want to address expectations for the Federal Reserve's next steps may be. For a while now, the Fed has been on a tightening policy schedule since they are concerned about the high inflation that we saw. Everyone is aware of how expensive goods have been lately. Just look at your last grocery bill. The Federal Reserve aggressively raised interest rates starting in March of 2022. However, since July of 2023, they have actually paused their interest rate hikes and have been monitoring conditions to determine their next steps. If inflation is still a concern, the Fed may keep rates where they are or even decide to increase them further. If they believe they are winning the battle against inflation, they may decide to change their course of action and potentially begin cutting interest rates. Jackson Hole is one of the Federal Reserve's largest conferences of the year, and Chairman Powell provided some insight into their current conversations and plans moving forward. Based on recent inflation and economic data, Powell hinted at the idea that it may be time to adjust their policy. They believe the inflation risks have decreased and they do not want to hinder the labor market more than they need to. It is our belief that we are likely to see the first interest rate cut in the U.S. since 2019 at their next meeting in mid-September. This does depend heavily on the economic and inflation data between now and then, but we believe the data, along with Fed Chairman Powell's recent comments, currently favors the decision to start easing policy. We are going to be watching this event very closely to determine the impact on our clients' investments so that we may respond with any potential changes that are needed. If you have any questions about interest rates or the Federal Reserve, please contact your personal advisor. We would be more than happy to sit down with you and discuss these ideas in greater detail. Once again, my name is Zach Bachner from Summit Financial. We appreciate you taking the time to watch this video. Please like and subscribe so that you can stay up to date on our new video releases. We'll catch you next time.
Summit Financial,
working with people you trust.